Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting. So the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life. Hey guys, welcome to The Big Picture. My name is Joe Cruy. I'm at Paradigm in the weeds around everything crypto vol markets. I'm joined here by my colleague David Brickell, as well as Gordon Grant from Genesis, who's becoming a more regular guest on the podcast, and very, very happy about that. Really glad to have you here, Gordon.
Greetings, gents. Good morning.
Yeah, so I think we should, obviously a big day, right, with the Chappelle upgrade. And I'm kind of excited because it feels like this is the first time this year on this podcast, maybe in the short history of the big picture, where we're not really leading with Bitcoin and, Bitcoin optionality, which has been the main narrative for the year. And so I think it'd be a kind of like a good start to basically frame the convo around, like what we've been seeing pre-upgrade and then what we're seeing this morning. So with the Chappelle upgrade, we had previously been discussing like this, lack of interest in Ethereum optionality leading up to this event, because you kind of had this unclear net outcome of, new interest coming in versus, outflows given the withdrawal flexibility, or potentially just because BTC had this more compelling narrative. And I mean, just like as a few data points, right? So in March, Bitcoin option volumes versus Ethereum were the highest since 2021. So on Paradigm, 77% of all the optional notional that was traded in the month of March, which was the biggest month for crypto options ever on us, was Bitcoin outpacing Ethereum 3-1. And then this chart on the right by Kaiko, it's a very similar phenomenon that's occurring in the spot markets, where Ethereum spot is only 30% of the volumes. And Gordon, I'm kind of curious in terms of what were you seeing before the event, right? The only flow that we were really seeing on Paradigm was, maybe we saw some covering of some 2000 strike calls, but this kind of just felt like, not really risk additive, more so like dealers covering before the event.
Yeah, I think that's right. I mean, Ether clearly suffered a case of what I would call asphyxiation by dominance, to put it neatly this year. And just looking at the chart, right, Bitcoin dominance bottomed at 41% in early to mid-January, and it's been on a tear, pushing towards 50% since then. And the story, the narrative that's driven Bitcoin back above the 30,000 level really hasn't impacted in any meaningful way. We all knew that the Chappelle upgrade was going to happen. We all knew about the of it and technological complications and thresholds about bonding periods, withdrawal limitations, and what could occur in respect to that. But it just hasn't really been part of the narrative. And we also all know that for a period of time, there's been a size overwriter in the options market, which really weighs on upside sentiment. Right? Every other day, there's a seller of 1,800, 1,900, 2,000 calls or call spreads in June and September in particular, which has driven this, most would say, pretty horrendous vol compression between Ether and Bitcoin right down into the mid-50s, even for mid-curve tenors like June. We saw a trickle from core dedicated clients of ours, who have been looking for a catch-up play in Ether, to start to scoop shorter dated upside in the weeks leading up to this event with a little more fervor over the past few days. And that's obviously built to something of a small fever pitch overnight, right? Vol on the 1 week tenor was as low as 53, 54 last Friday. It rolled up very fiercely over the weekend, such that you basically could have bought a strangle or a straddle and held it for free and not paid away any theta.
Right.
And there's been a steady demand since then. Most people are still feeling fairly complacent about Ether, right? To the extent that we were 1,900, we're pushing 1,000 today. It's not a market that's yet running away. But when we say that, it's important to remember Ether is a much smaller market than Bitcoin when it comes to options, when it comes to the ability of option market dynamics to influence the spot performance. And the amount of gamma and vega that's out there, still at the 1,900, 2,000 level is not inconsequential. So, in some sense, there's kind of this weird sort of, is it is it underpriced, or is there something going on of which I'm not aware? And so when we see people saying, okay, you know what, I'll scoop some short-dated optionality now, into the 60s. Well, ETH just moved $100, right? So that's a 5% move, inside of 24 hours, which annualizes to closer to like 100% than
Right.
60%. And so I think today for the first time, right, looking at the paradigm tape and seeing what's hitting, the blotter on the institutional liquidity network, much more of a Vega-oriented strip of trades on the tape, longer dated calls and call spreads, linear options, and a little bit more of a convex position. I think there are very sound kind of technical reasons to believe that if we can break out from the gravitational pull of those large overwrites, that we may see some significant acceleration to the upside purely from a volatility perspective, all else equal, right? And especially if Bitcoin is going to continue to remain well supported at 30,000 as it appears to be.
Right. Yeah. Those overrides are a big part of it, and that's flow that we really didn't see until after the merge occurred. And just for context, after the merge, on a monthly basis, we were seeing at least 80,000 Vega being delivered into the market via these systematic overwrites. I believe, so if you look on the screen as well, that fourth line, the SEP 2400, 2500 calls, we believe that this is that same entity that sold 30,000 Vega into the market this morning. It wasn't an overwrite roll, but it's something that has resulted in this, combined with the macro narrative that is, more conducive to owning Bitcoin versus Ethereum, that has kind of discouraged, in our opinion, a lot of participants from owning that Ethereum Vega. And I was kind of I woke up this morning, I was kind of quite surprised, to see this strong Ethereum bid. I thought this was gonna be a non-event, right? And now finally, we have these Ethereum flows and vols that are starting to wake up. We're starting to see that demand for that Vega. And so, just speaking to some of our clients this morning, some of our more sophisticated guys that are saying, look, Ethereum in the low 60s, that's pretty cheap. And when you look at it on a historical basis, and of course, there's more to just basically looking, oh, these are the lows, you should buy, for example, just because of, all those overriding flows that have really changed the dynamics. But if you look at that Ethereum BTC 1 month at the money spread, you could make an argument that the Ethereum vol is looking cheap. And, I think, that's also part of the reason why, spot's kind of waking up and we're going through 2000. There's definitely been some talk. I don't have the chart now, but, that GEX chart that's basically showing that there's a pretty strong short gamma concentration around where we are right now. So maybe we do get that leg higher, and honestly, it'd be nice to see, just because kind of feels like everything we've been talking about has been, Bitcoin related. I'm not sure how much conviction I have in that. It kind of still feels to me that Ethereum is going to play second fiddle to BTC, given some of the macro narratives at play, and this potentially could just be a short-lived phenomenon, just given we're so close to the event. But what's your view on that? Do you think that the ETH optionality is going to come back to focus? I mean, over the past 24 hours, I think it's like the first time this year or so, the Ethereum volumes are outpacing Bitcoin.
Yeah, I mean, I surely would not want to be short ETH Vega at these levels. Right? That would feel a very uncomfortable position. And I surely would not want to be getting shorter ETH Vega at higher levels of vol. That would also be a very uncomfortable position levels. As we know, ETH is a market that is much more susceptible of incremental flows than Bitcoin, where you have, I would say, a more balanced, heterogeneous assortment of traders, overwriters, miners, specs, retail, yield generators. ETH doesn't take much, right? As we know, $100,000 of Vega TradFi, it's not a lot, right? But ETH
No.
is basically this entire market here at this level. Well, what if someone came to buy $100,000 of Vega right now, right? Where's it going to go? And I tend to kind of look at the upside downside, and looking at how the term structure is performing today. Interesting to see that on a factor weighted basis, June is actually doing much better than you would expect, right? So your April and your May dates are up whatever 3 to 4 points, but June is up 2 to 3 points. for mid-curve tenor. And I think that's very telling. And if you're a large overwriter that short these strikes, you're going to have to buy those things back and either sell new strikes, or you're going to have to take a look and say, you know what, this trade was great, crushed it, made a huge amount of incremental yield accretion over a period of time. Is it time that I just don't give that back to the market, right, and allow ETH to have more of a geometric appreciation? Let's not forget about ETH. It's still a deflationary, right, asset. It's got a very demonstrable rate of token burn that we're seeing since the merge. It's still an apex crypto asset, maybe apex tier 1.5, but very much part of the fiber of this industry. I'm sitting here today broadcasting live from the Princeton Blockchain Symposium at the D Center. We just had Chairman Rusty Becknam of the CFTC say, listen, unequivocally from my perspective, there's a futures contract on it. It's a commodity, right? And he's clearly stepped up and said, Bitcoin is a commodity and ETH is a commodity. This is big stuff, right? So every other crypto, maybe it's a security, maybe it's at risk of that, but ETH is really cemented in place as a benchmark. There's no reason that respectively, if you're an asset allocator, if you are a yield seeker, if you are a treasury manager, if you are perhaps even someone from the TradFi space, sovereign wealth fund space, you won't start to look at a certain relative price point as a potential diversifier. And we've seen this in the past, right? We've seen when Bitcoin took off in Q4 of 2020, right, and broke through those 2018 highs through 20,000 and then went on to its historical run. ETH had a little bit of a lag, but when it catches up, it really catches up. So what that tells me here is you don't want to be short Vanna, you don't want to be short Vega, and you want to make sure that if you are playing this options market and you sort of care about convex exposure, you certainly give some deference to ETH in respect to its upside potential. It's very much the gold-silver dynamic of crypto that we've talked about many times in the past. Bitcoin being more of the gold-style options market, Ether being much more of the silver, like a platinum options market, which is far less liquid, far more flow-driven, far more gappy and kurtotic, which is saying something because Bitcoin is obvious all of those things and then some already, right? So, yeah, definitely respect the upside. I'm favorably inclined to it here, certainly from a volatility and purely quantitative perspective.
Good. That sounds really really encouraging. Like the comments from the CFTC on calling ETH a commodity. Because
I thought so.
Yeah. That's pretty huge. Now I know that to be fair, they've been leaning more that way in a way, and it's the SEC that are intent on calling it a security. But again, I think that's pretty big. And I mean, I've said on here before, right? Like the thing with ETH, obviously, Bitcoin's had like the digital gold narrative. You've had Gensler coming out like calling everything but Bitcoin a security. We've had the Shanghai upgrade coming up. Just Bitcoin's just been a cleaner trade, and obviously now we through that upgrade. It's kind of come off without a hitch. Doesn't look like there's any kind of significant selling pressure at the moment. It's kind of now time to play catch up, I guess, a little bit. And if you're starting to get comments from the CFTC sort of reaffirming it as a commodity, then all of a sudden you're building a nice narrative now around Ethereum to play catch up. I mean, Joe and I were speaking just before we come on the show about, I think we've underperformed Bitcoin by about 15-20%. So just on that catch up alone, like probably puts Ethereum around, I don't know, 200-300 or so, and then all of a sudden the 200-500 level becomes a magnet. So there's a lot of room to rotate out of Bitcoin and rebalance towards ETH. And I completely agree with your sentiments in that it'd be a difficult one to want to be short here and to be short the Vega on this.
Yeah, and flow wise, I think Joe can speak to this as well. We've seen some of our sharper takes come and start to put on these Bitcoin versus ETH vol spread trades. The challenge being we're still a ways away from having strike variance as an option for people to elect to trade in crypto, notwithstanding the recent release of devol futures, which I think even in their current state are far too illiquid to be able to support that kind of structure were it to exist for ETH. So it's hard because most of the folks that we've seen putting on those trades have been doing meteor at the money strikes just to get as much Vega on long ETH and short Bitcoin. And the problem is, of course, that in a geometric rally, right, for ETH, where you find yourself back at 3,000 or 4,000, you're going to blow through those strikes and not have exposure to the fixed strike vol that you actually want, where you could really get outperformance versus Bitcoin. And of course, that's one of the tricky aspects of trading this. We've also had people look at ETH BTC outperformance. We have traded at Genesis those ratio options in the past with some of our more dedicated, sophisticated institutional grade clients. We've seen a renewed interest in those recently, and quite clearly, the ETH BTC cross vol has had far more life in the last 3 months than it's had at any time previously, where realized correlation between ETH dollar and Bitcoin dollar pair was upwards of 85%. Really wasn't a lot to say about that other than, well, there could be certain scenarios in which there would be a decoupling. But Q1 was very much about decoupling between Bitcoin and ETH. Could Q2 be about a sort of recoupling or decoupling to the top side of ETH? It's entirely possible. People have a lot of wins in Bitcoin. There's a lot of liquidity in a salubrious fashion that's been created by the resurgence of Bitcoin. It's at a level now where there may well be two-way flow, and it could support, right, let's say a more sustained and idiosyncratic move to the upside by Ether, particularly if CFTC is starting to talk like this is definitively a security. It's going to remove some of people's uncertainty about it or the willingness to participate in it. And now with staking, right, you get 5% yield or more if you take this and park it on main chain or via a staking service that you believe is safe from a regulatory perspective, and it's not going to allow it to be designated a security. And that's neither a recommendation for or against staking your ETH, but it's an consideration when you talk about how you treat this asset and what you do with it. But certainly its yield as compared to Bitcoin is a factor, right, that can weigh into people's minds, especially in a world of 5% dollar interest rates where you've got a positive carry in ETH, but a negative carry cost to be long Bitcoin at the curve.
Yeah, I think there's certainly some potential for that spot and in vol reversion. In terms of speaking with customers in Q1, seemed to be a fairly consensus trade that the Ethereum vols were gonna come in relative to Bitcoin, especially when we had that really sharp rally, in January. So, speaking to some of our customers, especially like dealer community, buying the BTC, getting lift, but then over the counter, these guys were getting lifted out of Ethereum upside and effectively just running that short versus BTC. And then kind of in the lead up to the Shanghai upgrade, starting to cover some of that short Ethereum that they were using to fund that long BTC. And hell, I mean, we're even seeing some of that even more this morning. From what we've heard, there was a fair amount of short-dated OTC flows that were being bought. I mean, look at the third line, 7,000 of those April 21s, 2,200 calls being bought. In our view, and even before the merge, or not the merge, the Shanghai upgrade, we saw a lot of those 2,000 calls being covered as well. So it could be the case that this is, this unwinding of this spread is something that potentially takes us back and provides that catapult for spot and vol higher. Gordon, you're on mute.
I was just going to say optically, right? Taking a look at the order book here and seeing where, there's actually still a good depth of liquidity. Your, 40 to 50 delta strikes for, Q4 and Ether still, these are not even 62 vol on the offered side. It's really quite incredible in that respect to think that we've had these moves. But, pattern recognition suggests that when things start to boogie, you get demand in the front of the curve at first. You will get some backwardation of the term structure of volatility. And eventually, if the move sustains itself, you get players who are better capitalized with P&L behind them to be able to reach for Vega and wing your options. And that, I would say, is more of my central case for thinking about how Ether, options market and volatility surface can evolve from here, for sure.
Do you think there's any psychological damage from the merge last year when we saw funds putting on some sizable sort of topside sort of Vega plays and some really wingy stuff, and obviously we didn't get anywhere near that, and not because of ETH necessarily, but obviously things that happened, be it with FTX and what have you. Do you think there's some once bitten, twice shy type psychology behind it that people didn't want to go pulling on sizable trades into this event?
I think so. I think that's right. Going into the merge was sort of the second and a slightly less pronounced vol in Ether that we have seen since 2021. Everybody remembers the Q3 2021 volatility squeeze that was at least in part catalyzed by some of the comments of a well-known Twitter proponent, who suggested that the best trade for folks to do was go out and buy 10,000 plus strike calls further out the curve to gain what we would consider to be an upside convex exposure to ETH. And that drove vols from, let's say, the upper double digits well into the triple digits from those strikes. We saw similar activity again around Emerge to a lesser extent, but we still saw ETH falls well into the triple digits. And of course, volatility simply did not perform on an implied basis post-merge. It was some of the sharpest IV deflation I've seen in my lifetime, with IVs dropping quickly across the curve from, the low to mid triple digits all the way down to about where they are today, right, from 90 to 80 to 70 to 60 in very short succession. So yes, if you're a risk manager or a risk taker, if you are a portfolio manager or an asset allocator, you really have to have, I would say, this time it's different thesis to step up and long a significant amount of Vega here on ETH. If you're a market maker or a dealer book, given the relative paucity of liquidity in Ether options markets as compared to Bitcoin, you also need to have a this time it's different thesis, because your expected hold time for any given ETH position and your expected edge capture in the event that you need to liquidate on a risk-adjusted basis is far less than Bitcoin, right? It is starting to suffer from those same ailments as, let's say, the silver options market compared to gold, to use the prior allusion and analogy. I think it can change. I think liquidity can get back in, but we will really need to see more retail adoption, within the ETH option space, whereby dealers who are holding Vega in those convex positions could get paid out of them by retail flows, and whereby we see more institutional grade takers, as the kind that Joe has mentioned, get back in and start to utilize derivatives as a way to express directional views on ETH. Will that happen? Less clear. If you hold ETH, maybe the best thing to do in some people's minds is simply to stake it on main chain and earn those kind of juicy rewards. If you're long it in a derivatives perspective, you don't get that incremental yield. And as a result, maybe the characteristics of ETH as an asset are changing, or at least the characteristics of the class of takers that want to express directional views on it are. We'll have to see. It's a very interesting dynamic. Call skew is not the cheapest I've seen it here, right? Looking at the curve to September, we're seeing, 2,500 strikes, which are almost 50 delta at this point, offered at under 62 vol in December. And your 10 delta strikes are almost 74 vol. So 12 vols of skew for the 10 delta point versus the 50 delta point. It's, I would say it's a fair value price for having the optionality on vol. Not rich, certainly given the potential for Ether. And if you're talking about holding a 5K strike, could that trade upwards of 90 or 100% implied vol if Ether really gets going? Yes, absolutely. But you're also going to pay away a heck of a lot of smile decay to hold that position if it doesn't perform. And for people who don't have the ability to warehouse that risk, it's a painful proposition to sit on something like that without any natural flow to offset it.
Right. Cool. Makes sense. I think it's a good segue now into the macro, David. Obviously, big CPI print yesterday.
Yeah. I think like the macro just continues to play out, Joe, as we've kind of outlined for the last few months, and it continues to kind of follow this sort of peak inflation, peak rates, peak Fed thematic. Look, everyone, like there was kind of something for everyone in yesterday's CPI data. Obviously, quite a big fall off on the headline from 6% to 5%. Core was actually up from 5.5 to 5.6. But I think the kind of general sort of trend is we've seen the peak on inflation. That's really been supported today by the PPI data. So you saw headline PPI come in at 2.7, down from 4.9% the month prior. So I kind of think, given some of the sort of definitely two-sided risks to this market from a growth perspective, from the banking sector sort of instabilities, there's plenty there for the Fed to take the pause in May. Now, I think market's pricing like 70% for a 25 bip hike. That looks a bit high for me, so I actually think there's room for that to come a little bit lower, just sort of given the data. Also, something else that was interesting to me, last week, we had a really poor run of data. we actually started to see some cracks in the labour market. It seems a long time ago now, but the JOLT survey, we saw job openings fall below 10 million. I think that's like the first time in 2 years that we've been below that number. We saw some massive upward revisions to sort of jobless claims. So we started to see some cracks there, and then you had like confirmation that the manufacturing sector is still massively in contraction territory via the ISM, and then for the first time we start to see the service sector through the services ISM look like that's starting to get hit as well. Not quite in contraction territory yet, but still, you know, we've seen some big give back there. So I kind of think the data is really slowing. You know, and we are going to reach a pause. So whether the Fed hiked 25 bips in May or not, it looks like it's that and done. Now, granted, the market is still pricing in cuts for the back end of the year, but you know, things can sort of change pretty quickly. And I'm conscious of the fact as well within the macro that we're seeing the inflation data slow. I keep saying that there's, you know, about a 12-month lag between, you know, in the transmission of Fed policy. You know, 12 months ago, we'd only just started the hike cycle. So there's a lot of lagged impact to start to bite. And that's on top of the fact that we've had this banking sector stress that started to really weigh on credit. I think the last two weeks of March, sort of bank lending contracted like 105 billion or something like that. So I think there's some really sort of big disinflationary factors at play that keeps us in this sort of peak Fed narrative. We're approaching the pause, and I still think markets are kind of under positioned for that, for this change in that macro dynamic. So yeah, like the macro for me is looking good. I still think we get a continuation of the themes that we've seen so far in to start the year. So, I mean, 30K in Bitcoin, I guess a round number. Everyone kind of always wants to fade round numbers, but I think this is just getting going, and I don't feel the market's particularly heavily positioned for the top side. In fact, I'd say we're under positioned. The other thing that's interesting to me on the macro is I always look at China, and the China credit impulse is starting to pick up as well. We had sort of loan and credit data out yesterday, and total social financing, I've written it down here, was 5.4 trillion yuan in March. That's up from 3.6 trillion. So China, as they kind of battle their own slowdown, are starting to really sort of pump credit into the system. And there's actually a pretty strong correlation between the Chinese credit impulse and what they're pumping in with Bitcoin, as well as sort of domestic property and equities in China. So again, I kind of think you've got a nice liquidity narrative that is still going to underpin this market, running alongside the fact that the Fed are approaching a pause. I guess the offset to that is the worries about recession risks. I'm not so worried about that. I still think we're a function of rates and liquidity. Yeah, I kind of think we're going to be all right. So yeah, look, I'm still pretty bullish on crypto and what's ahead. I like the conversation here around, you know, the potential now for ETH to catch up. So I kind of think with the Shanghai upgrade out the way, you're going to see some rotation into that and some catch up trades. So yeah, I think we're just getting going. Interested to hear your thoughts, Gordon.
Yeah, it feels right. I mean, look, we were just discussing yesterday amongst ourselves, you know, a bit of a boys get together and saying, all right, so how many markets do you know that just do an 80% rally and just sit there and chill? I haven't seen it too often, right? It's not many markets. Crypto periodically does it, right, where we have these step function moves, these sort of syncopated gaps higher, and then we reprice to an equilibrium as unsteady as it is. But the fact that we're up here 30 quite comfortably, I think, the way that we're trading, limited pullback, no drama, no spike and dip, even as we saw the first time we pierced 29, seems to validate your thesis, which is to say there's clearly going to be some supply from the mining community. I'm excited to see the numbers from Bitfarms, Marathon, Riot, and others who likely would have been selling into the month of March. We haven't seen, from our flows perspective, that many significant bullish bullish option structures being put on since we pierced 30K. It's almost incredulous, right, that you would see the market act in this way and people not coming out to ape into call spreads, risk reversals, 1x2s, anything that would give you levered gearing to the upside. After all, this is the market that lives on this fat-tailed serial autocorrelation. And we're just not seeing people playing for that. I think it's partly due to the fact that, as you say, once bitten, twice shy. No one wants to say I was still a bag holder at 30K after a searing 50% rally when, well, we know any number of things are lurking out there, including regulatory FUD, including, an ostensible negative disposition of, the, say, Western alliance to things that kind of hit at the cracks of the foundation of the banking infrastructure. But here we are, and the market is trading that way. It does very much feel a little bit like that market from let's say summer of 2021, where, hated it at 15, sort of disliked it in the mid 20s. I'm indifferent to it at 30, but at 40, I'll buy this, right? I'm high on at 40. Mm-hmm. And as a result, maybe we will see some acceleration to the upside if we get there. I don't see the policy-making rhetoric dialing itself back. You kind of have to take it for what it is. I think we have to appreciate and respect the strength of the policy-making community by the tone that it sets. What was the number one statement that came out of the IMF spring meetings this week? It came from Christina Georgieva, who said, "We believe that the fair value terminal rate for monetary policy in a developed market like the US or Europe is 1%. 1. Not 2, not 3, not 4, not in accordance with the rate of inflation, just 1. And there are obvious reasons why they would like it to be 1, including the fact that the overall financial stability and health of the banking system is significantly bolstered, and the finances of the IMF member countries are significantly bolstered if policy rates are that low, because fix this massive hole in the balance sheet of institutions that levered long duration at absolutely horrific levels. But that's the dream that they want to sell to people. And as a result, I don't see a narrative in which we're going to be talking about runaway inflation, even if it's really there or is not going down as much as people want. And overall, right, we're also seeing people talk about the need for other kinds of macroprudential or fiscal measures to tend to areas of the economy that are neglected or otherwise haven't participated in the growth cycle. And let's be serious, right? This is not a sort of a far into the tail view about the distribution of economic policy or the course of human events over time. Policymakers rely on controlled seigniorage and monetary value debasement in order to support economic growth. This is a fact of life. That's why people prefer positive rates of inflation to negative rates of inflation. This is why the idea of printing paper money and running it as effectively as a business is part of how the West functions. It's not an indictment of that policy. It's not to say that this is all going to blow up overnight, but it's simply going to say we're at a point in the cycle where we hit the pain threshold, where tightening appeared to be breaking things. And policymakers now, particularly after the words of the CFTC chairman at the symposium, are, I think, deathly afraid of inducing any further detrimental measures that would jeopardize that stability, right, or the sustainability of the legacy system as we know it. So in that context, I feel constructive on crypto. I think there is always scope for a pullback. There's leverage that's entered the system. It's entirely possible that if we break through key technical levels at 29 or 28, could we have a quick pullback to those breakout highs in the mid-20s? Sure. Obviously, it's Bitcoin. But
Just something within that as well that I find interesting is like the price action for me is like super constructive. Like we've had to have like an 80% odd move. You kind of had this move to 30K. Like pullbacks have been minimal, and like anyone looking for a dip to get in, like you've not really had a pullback. And it reminds me actually over the past year, like when we were selling off, when the sort of weight of flow was the other way, you never really had a big bounce to get short or to get that trade on. So it just all feels very orderly, and it doesn't feel like a move where there's kind of any exuberance or any kind of FOMO. It kind of just feels like a slow, orderly kind of grind higher, punctuated maybe with some short liquidations that give us a few of those little legs up. But yeah, there doesn't feel like there's any kind of exuberance. Joe and I were talking earlier about it still feels like a lack of retail participation. Now that doesn't feel like it's going to come from the US, given the stance of things out there. But obviously in June we've got this big thing happening in Hong Kong where we can start to see some Asian money and big size Asian money from the retail community start to come into the space as well. So yeah, it just feels like constructive. I'd worry if we'd got the move up here and it was like a volatile sort of whippy sort of move, but we're nowhere near those kind of blow off top type scenarios. And then the other thing as well to me is a lot of the funds and people that I speak to have kind of missed the move for Q1 and they're kind of chasing performance. And it's difficult if you're a crypto fund, a Bitcoin fund, if you're massively underperforming the actual move in Bitcoin itself, then you have to kind of be involved at some point and kind of almost just kind of start reweighting and having some size in this move. So I still think there's a lot of money to come into this into Bitcoin and obviously Ethereum and the wider space.
Where do you think? So if it's not coming from retail, where does that impulse come from? Gordon, I know you have some interesting and unique views around sovereign wealth coming into the space, and that coupled with the fact that crypto on-off payment rails are kind of a shell of what they were. Order book liquidity is not there, right? You get that strong impulse from maybe a sovereign wealth. It's going to move, and it's going to move quick.
I think so, right? We're seeing sovereigns take decisions that have heretofore been inconsistent with prior policy practices. That includes comments from folks like the European Union saying that we're just not sure we should get ourselves involved in other people's crises. That's not a statement about Bitcoin. That's a statement of, I would say, autonomy in terms of their overall thought process and regime. We're seeing countries like Saudi Arabia, a longtime partner to the U.S., doing things that are not consistent with the prior, our life is in dollars, our business partners are in dollars, and we look west, we don't look east. And we're also seeing tactical moves by regulators. It's very encouraging to see what Hong Kong has done. They've made a complete 180, in my view, from being anti-crypto to being very pro-crypto, and realizing almost in a sense that a mea culpa and trying to bring people back into the fold is value accretive to what they stand for, is an independent nation state, notwithstanding its ties to China, that is for open capital markets and innovation. Right? A Hong Kong that clamps down on crypto, that wants to walk the clock backwards, is not the brand of Hong Kong that was founded by folks like Li Ka-shing and others. That can bring retail in from sectors that were previously either afraid to touch it or discouraged from touching it. Let's not forget, there was actual Chinese state media less than a year ago that came out and said holders of Bitcoin should sell everything because it's worthless, right? That was like a real statement that came from state sources. I don't think that that's the tone that is being transmitted now, given the stance that Hong Kong has taken. We've seen Singapore at a sovereign level make its second largest ever gold purchase. Also, another significant data point, MAS isn't buying Bitcoin yet, but they're buying something that serves a very similar purpose. They are value-oriented buyers. They're not buying gold at 2,000 because they're momentum players. They just don't know what else to buy. And the price action that's been mentioned here is consistent with a bid under the market from a player or a number of players that at this point remains somewhat inexplicable, a bit Loch Ness Monster, that anytime we really find that we're selling off to those key levels, it's right there, right? The way it was at 20,000 in the midst of the silver price. Just sat there at 20,000 incredibly tranquilly before it had this, geometric move. It's sitting up here at 30,000. Yet again, any dip below 29, extremely well absorbed, and we've seen it all the way up. Could that be a state actor? Quite possibly. I'm more of the view that it's a number of state types, in the sense that there are people who use Bitcoin for real world activities. Let's leave it at that. They don't want to use dollars. They don't want to use SWIFT. They don't want to use other kinds of activities, either for reasons of convenience or regulatory scrutiny or strictures, and that this has become an instrument for financial transmission in the way that it may have originally been intended to when it was designed. And that also keeps a bit under the market. folks are not necessarily keen as they were in the past to hold on to all of their dollars for reserve management purposes. And if Bitcoin is being used for real legitimate trade flows, even if it's being traded back and forth, there's going to be that bid under the market. And I think the other component of this too, and we discussed this, show is how much selling pressure is there on Bitcoin for folks that are mining it in other quarters. Yes, there's been a lot of miner selling that's been quickly absorbed at lower levels that are now 30, 40% below this market. But there are now people mining Bitcoin, starting to mine Bitcoin, who do not sell it, particularly in the Middle East. And that's a very new dynamic. And so if you put those together, you can see greater potential for this kind of ratchet effect, whereby incremental supply is leaving the market. Bloomberg, CoinDesk, and other reputable news sources have noted the number of Bitcoins that are moving to personal wallets, which seem to suggest, according to historic metrics, a tendency to want to hodl, right, even at these prices. Not surprising, people are scared about banking system stability and, the viability of holding dollars in a bank or holding other fiat currency. But we're also seeing emerging markets, right, consistently having currency crises whereby Bitcoin actually offers some utility to them, whether it's in Nigeria, right, whether it's a country like Sri Lanka, whether it's a Latin American country like Venezuela or Argentina, where there is persistent policy heterodoxy. That's another source of a bid for Bitcoin. And collectively, it can create the kind of dynamics that we're seeing. I think as observers, as watchers, it would always be interesting for us to imagine, what if the PIF is going to announce this year that they aped into Bitcoin, and wouldn't that be fun? Capable of it, they bought a bunch of credit Swiss stock, which is now worth. So, buying Bitcoin doesn't sound that crazy now if you lost all your money investing in one of the world's supposedly most robust and august financial institutions. But I tend to feel that it's more a disparate set of players acting not necessarily in a cooperative fashion, because this meets some needs of theirs, right? In the current policy environment, we're not seeing policy rates being tightened. We're not seeing access to dollars being made any easier. Let's not forget, right? Russia is not being welcomed back into the fold. They're not told that SWIFT is open to you and your banks. We're not being told in any stretch of the imagination that there is a nuclear deal with Iran whereby they would have an ability to sell their oil for dollars and bank in dollars again. These things matter, right? And it's a choice. It's a conscious policy choice that has now, for the better part of a decade, driven people out of dollars and into alternatives like gold and maybe even Bitcoin, right? Let's see.
Cool. David, do you have any final thoughts?
No, I mean, I think, I mean, that's a really probably good point to kind of end things. But yeah, just final thoughts. So yeah, like I think we're at a really interesting juncture in the things that have driven us here. This sort of digital gold narrative, the sense that there's still a lack of participation in this market. And I think everyone just feels it's going to fade and fizzle out. And I think to Gordon's point earlier, we kind of seen that before in 2021, and then we started to sort of really climb. So I think it's going to be really interesting to see how things play out over the next sort of few weeks, because I kind of feel like there's going to be some towels that get thrown and people just get drawn into this market because they just have to be in it.
I think that's a great place to leave it. Gordon, thanks so much for joining. Enjoy the rest of the symposium.